Good evening, everyone. Welcome to our KU Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thanks so much for taking time out of your busy schedules to be a part of tonight's session. This is a class that we put on 4 times a year, so it's usually done once per quarter in partnership with the Alumni Association. And I'm glad you guys got a chance to hear about this and really excited to bring this content to you. We are recording tonight's class, so if you have to step away from your computer, we'll send you the link to our YouTube channel. You'll be able to access all this information tomorrow. And we'll also provide all of our slides from tonight. So I think we have a lot of great information to share with you this evening, but we'll be able to send all of this information back out to you again as well. So thank you so much for being a part of tonight's session. My name is Jason Maida, so I'll be your facilitator this evening. I work for an organization called American Pacific Mortgage, and we work in partnership with the KU alumni to provide resources like this to our communities that we serve all across the country. I was fortunate enough to be on campus just last month, got a chance to see KU beat U of A at the field house. It was awesome. Just kind of solidified for me being a part of the culture of KU, just how we really enjoy serving the KU community and just being a part of what's going on is really exciting. So really glad that we could be a part of this for you tonight. We're going to be talking a little bit about first-time buyer programs, a bunch of different resources that are available to you as you decide to take this journey towards homeownership. Here's some of our talking points tonight, which will include what's happening with the housing market, maybe in your local market or just abroad in the country. We'll talk about interest rates, which I have a lot to talk about on interest rates because there's quite a bit of volatility in the interest rate markets. We'll look at credit because credit can influence your cost of buying, whether that's the product you select or different elements that make up the overall payment for you with your mortgage. We'll talk about different programs that are available to you. We'll talk about savings for homeownership, which tends to be one of the bigger challenges for a lot of clients that are thinking about purchasing. But we will look at also first-time buyer programs that are available to you in your local market. And then we'll wrap up tonight's class looking at the buying process. So where do I go from here? After tonight's class, hopefully you have one or two key takeaways that are really kind of resonating for you. Where do we take that and then kind of move into home ownership from there? Now, whether you're thinking about buying this year as a financial goal, or it's maybe 2 or 3 years down the road, hopefully a class like this will kind of spark some thoughts for you that you want to purchase at some point in time. But I want you to kind of know, where do you go from here? What's the roadmap to home ownership, right? So that's kind of our plan for tonight's discussion. This is a very interactive class, so we always encourage you to ask questions of us. So we'll have the chat feature up as well as Q&A. My colleague Ken and I will be answering questions that come up. I'll also kind of be monitoring both of those windows. We'll also carve out some time later on in tonight's class to maybe dive into any questions that we have. Okay? All right, so that's our plan for tonight. Thanks again for joining us for this journey into home ownership. And as we think about home ownership, we really want to think about this as an asset, right, that we're going to be buying. It does have an opportunity to create better affordability for us. So hopefully we're going to find a payment that's equivalent to our rent maybe, or something lower. Maybe it's a little bit higher, but ultimately you have the opportunity to create more of a fixed payment when you're a homeowner versus being a renter. Many of our clients that are buying in today's market, that maybe they're buying at higher interest rate levels, will have the opportunity to refinance at some point in time as rates go lower. So we're actually having some of those conversations now. And as I just mentioned, this is an asset. So it does have the opportunity to grow in equity over time. So if I buy my home for $400,000 and 10 years from now, it's worth $500,000. Now I've seen my asset grow over time. So as I can continue to pay down my mortgage, which is basically that principal reduction, and that home goes up in value, that home equity is really a really large part of our financial wealth for many of us. It's probably the most or the largest asset, I would say, in addition to like a 401k or a retirement account that we have. This also can create some tax benefits for you. So depending on what tax bracket you're in, you could have some tax deductibility benefits. Also, when I decide to make improvements to my home, like maybe an energy efficient improvement, that can also create some tax benefits for me as well. So I always encourage clients, especially when they come to class like this, to think about home ownership from the lens of, this is really an asset opportunity for me, but is a wealth generation opportunity for me. And it's really not the same when you compare renting versus owning, right? It just looks a little bit different. to help illustrate that point, what I thought I would do is kind of jump into one of our calculators that we have available to you, which is our rent versus buying calculator. And it's a great way to kind of get a better picture of what home ownership looks like for you. We have a lot of great tools available to our clients, and these are some of the other calculators that are available to you, like affordability calculators, refinancing, general payment calculators. But I thought for tonight's class, we could just spend some time looking at a rent versus buying situation. And depending on what market you're in, right, it's going to drive the cost of home that you're looking at, whether that's in the Kansas City market or Denver, Colorado, or down in Dallas, Texas, whatever the case may be, it's going to drive that price of home. For tonight's discussion, I thought I would use like a baseline price of $300,000 for this calculator. And I'll walk you through this tool. Now, I would encourage you after tonight's class, if you do have some extra time, maybe dive into this calculator on your own. I really think it's a great way of kind of like teeing up home ownership for you, so you have a better idea of what's going to be the upside in for me owning a home, right? So let's assume a $300,000 house for this calculator, 3% minimum down payment. We have our loan amount, which is 97% of that purchase price. Put an average interest rate in. We have a 30-year fixed mortgage, which for most of us, we're probably going to elect a 30-year fixed mortgage. This makes the assumption that we're going to buy sometime in April. Obviously, that could change depending on what our plan looks like. Now, when we purchase a home and we put less than 20% down, there is going to be mortgage insurance. We're going to talk more about PMI, private mortgage insurance, later in tonight's class, but there are factors that make up private mortgage insurance. So we're going to put that factor at 0.37 right now. We have homeowners insurance costs, which will vary based upon where in the country I'm buying and what maybe elements make up the cost of insurance, like natural disasters and stuff like that, fire zones that could impact insurance. We have tax rates. If we're thinking about buying maybe a condominium, maybe maybe a townhouse, they're going to have HOA dues. We didn't put that in our exercise here for tonight, but that could be something that you want to factor into your expenses. The tax bracket that you're in, we want to factor in repair costs. So if I have to do some upkeep or repair or maintenance to my house, what does that look like? Selling costs of my home, because at some point, this might be a building block house for me, where I'm getting into home ownership. I'm seeing a little bit of appreciation, and then ultimately maybe I'm selling my house to buy something different. So we want to factor in selling costs, assuming my home goes up maybe 3% in appreciation on an annual basis. So that is all the side of the buy side, right? Now on the rent side, it's a little more simple, because maybe I'm paying $1,500 a month in rent. We have renter's insurance costs. And then we want to also make the assumption of how much is my rent going to increase annually, right? So if we look at our calculations, what this does is it says, okay, well, Jason, what's the break-even point of owning versus renting? And so right now, our calculator is telling us that if once we hit the 3-year mark, everything above and beyond that, we're on the positive side of home ownership, meaning the investments I have to make, the tax deductibility benefits I'm getting, and I overlay that with what my costs and rent look like. I'm going to break even in 3 years. We generally would want a client to break even in less than 4 years. So this math works right now. Now, if we push this calculation out to say 7 years, now we're ahead of in the plus side, or the positive side financially, right? At the end of 7 years, our buying opportunity is a $41,000 gain at that point. Now, that's if I decide to sell my home in 7 years. What if I decide to sell my home in 12 years or a longer amount of time? Well, then my home should continue to just go up in equity. Now, home appreciation is not this like kind of linear thing, right? It does have cycles in the real estate market, but after 13 years, that $300,000 home is almost $123,000 gain opportunity. So those are the things that I would encourage our class to think about when it comes to home ownership. This is truly a vehicle for you in wealth creation. Now, we understand the entry point is not the same for every client that we work with, but I think a calculator like this can really help to give you a different lens into home ownership. All right. So we'll get that tool out to you tomorrow when we deliver the presentation material. Now, your entry point to home ownership also can be directly impacted by what your respective housing market is doing. Whether you're in the California market, Texas, Colorado, or looking at the Kansas housing market, every market has a different entry point to pricing, and the appreciation rates look a little bit different, right? And I think really right now in today's market is what's the supply look like? Is there homes for me to choose from? Most markets are starting to see better supply opportunities, but there's other markets that have a backlog of supply, more supply than there's buyer demand, like Texas, Georgia, Colorado, Florida. They all have kind of a backlog of supply, at least what we've seen over the last 3 to 6 months. In the Kansas market, median sales price is 286. You can see median days on market, 46 days. Housing markets will also cycle with the better weather. So when I was in Kansas, it was a rarity. It was a Sunday, it was like 60 degrees, which I know a week prior it was certainly not that. But as weather gets warmer, we'll start to see more buyers get active in the market. And now sellers, as the snow kind of melts away, we'll see sellers like re-engage and say, okay, I'm going to put my house on the market. That, of course, gives us more supply too. So supply has been the biggest challenge in the markets for the last 2 or 3 years, but that is starting to improve. And you can see kind of with our market in Kansas in particular, we're seeing a little bit of an uptick in price. Okay, not a ton, but a little bit of uptick in price. So if you're an existing homeowner, that's great news, right? That means I'm having a little bit more equity in my home. The Kansas market doesn't traditionally appreciate really significantly in short amounts of time, but to see that uptick in price, if I owned a home right now, that would be really great news. We'll talk more about kind of what we're seeing as kind of our projections in the market in just a bit, but I also want to spend some time talking about interest rates. And we were on a nice little ride in interest rates on February 28th. We were super excited because we saw interest rates getting really close to dropping below 6%. Well, that has changed quite a bit over the last week and a half, 2 weeks with the conflict in the Middle East. And we just put a post out on our socials on this. Oil prices have really driven up interest rates right now because there's economic indicators that we've been watching at just in the US economy, like inflation and employment numbers, but those numbers are going the right direction for us when it comes to interest rates. But unfortunately, a lot of the improvements as it relates to those indicators for interest rates has been overshadowed by the cost of oil. Oil prices have now, I think today, as of this video, I think they're right around $93 a barrel. They were as high as $100 a barrel on Monday. And so, that is really putting some strains on the markets. Now, I think we'll ultimately kind of get through that right now, but we don't really have a timeline on that. So we're seeing interest rates start to bubble up to like the 6.25 range, some higher depending on the product. This is going to be a very volatile market right now until things get kind of sorted out globally, right? So we're watching that really carefully. That's one of the things that we do with our clients as we kind of are a little bit closer in the home buying phase where let's say we're under contract with a seller, then we're having more strategic conversations as it relates to locking in an interest rate because interest rates change by the minute when you're in the home buying process. So when the financial markets open on Wall Street, now the rates will change up and down throughout the cycle of the financial trading day. And of course, we're watching that really carefully for our clients. I think the projection long term is for interest rates to go lower. But I think a lot of what we projected in this year's interest rates, which we thought we would sit probably 5.75 in interest rate by end of year, may look a little bit different depending on how long the conflict continues in the Middle East and really, again, what happens with oil prices. All that being said, I still think there's really some great entry points to homeownership right now because for most of our clients that are considering homeownership, it's probably not the forever loan. So even though we're going to more than likely look at maybe a 30-year fixed mortgage, doesn't mean you're going to keep that loan for 30 years. You'll probably keep it for maybe a couple years because interest will eventually cycle lower. Every interest rate is not the same for all buyers. And I think that's a bit of a misconception in the market, especially when maybe you're doing a Google search of interest rates or whatever the case may be. Interest rates are made up by your credit score and eligibility, the type of product you're going to select, how much you finance with us, what your down payment looks like. Sometimes clients will consider buying down an interest rate, which is essentially putting more money out of pocket in order to bring down that interest rate. Usually the cost of an interest rate buy down is 1% of your loan amount, and that will generally equate to about a 0.25% reduction in interest rate. Not an investment that I would really recommend clients doing unless they're getting some participation from a seller to help with that cost, because the break-even point's about 3 to 4 years for most scenarios. And as I just mentioned, most clients are probably going to refinance in a couple years. So you wouldn't want to outlay that investment of a buy down of rate if you're going to turn around and refinance in a couple years. The term of my loan can also impact my interest rate. So the shorter my term of my loan, that can also bring down the cost of my interest rate. So as we get a chance to meet with you for maybe a consultation at some point when you're ready to take on home ownership, we're going to kind of figure out what the right framework is for you with your home buying plan. That may be a 30-year loan. It might be a 15-year loan. It might be incorporating assistance programs, but each scenario that we look at will have a corresponding interest rate. Okay, so when we think about building a plan for homeownership, credit is something that we're going to have a conversation around. And every loan program does have a minimum credit score. We've highlighted some of those programs here on screen. Generally, the lowest credit score for homeownership is going to be a 580 credit score with an FHA or Federal Housing Administration loan that is government insured that we'll talk about in just a second. Now, when we think about credit scores, we always take the middle score of all three agencies that report out. So those three agencies are Equifax, Experian, and TransUnion. I mean, you guys are all familiar with those. Now, we take the middle credit score of each of those. So if I have a high score of 760, my middle score is 740, and then my lowest score is 720, well, we're going to take that 740 credit score when it comes to qualifying. If I'm going to apply with my partner, but let's say my partner scores are slightly lower, maybe they're 700, 680, and 660. Well, their middle score is 680 minus 740. So from a lending perspective, we will take that 680 middle score for the partner, which will also influence my interest rate opportunity. It'll influence maybe the cost of mortgage insurance, maybe even the product that we're going to select. Okay, so that's really important when we think about credit scores. Now, I'm going to give you some tips in just a second about how to maximize credit score. But when we look at past challenges on your credit, maybe you've had a late payment on a student loan, maybe there's a collection account for an old utility bill, whatever the case may be. If you've had any type of negative items, they're generally going to impact your score in the most recent 12 to 24 months from the date that negative item appeared on your credit report. Okay. So that's important to know. We're going to talk about credit utilization just a bit when we go through kind of the credit score opportunities. But I just want to kind of share with you kind of a few of those kind of high level things that we look at. Now, when it comes to delinquency of credit, here's a matrix that shows you how long those items will stay with you on your credit report. So if you've had a hard inquiry, it's not necessarily a negative item. But if you've had multiple hard inquiries, it can negatively impact your score. There are rules in place for credit inquiries that when I'm doing a mortgage application or a auto financing application, I have a 30-day window of time to speak with as many lenders as I would like to figure out my financing. And it's the equivalent of one credit inquiry hit to my credit score. All right. Now, negative items like a late payment. Let's say I had a late payment on my student loan in October of 25. So that was just, 4 months ago. That's probably going to have a pretty negative hit to my credit score versus if that late payment was back from 2023, it's over 2 years. So it's probably not hurting my score as much. So generally speaking, when we've had negative items on our credit report, that most recent 12 to 24 months is really going to be key for how it impacts our credit score. As I move further away from that event, then I should start to see some organic improvement in my credit score. All right. Now, this is the mortgage credit score model, okay? And there are 3 different models to scoring. There's credit cards, which, by the way, most of your monitoring services like Credit Karma, some of the tools that are available online, they're going to use the credit card model, which will look a little bit different than the mortgage model. So I get that often from our clients. They'll say, hey, Jason, I just pulled my TransUnion score at 780 today, but then we pulled the mortgage score and it's like 760. The reason for the difference is that there's different elements that are weighted differently in a mortgage score versus, say, a credit card score. So let's take a look at what that looks like. So 15% is going to be how long have I had credit? So the more mature my credit file is, probably the higher my credit score is going to be. So if I can have more seasoned credit, like I said, I'm going to have a better credit score. How much credit am I trying to get access to is 20% of the weighting. So if I'm opening up a bunch of new accounts, especially in a short period of time, I'm probably having some pullback on my credit score. We're also watching carefully what inquiries look like, because if I'm doing a bunch of inquiries, that means I'm trying to obtain new credit. So we want to be mindful of that. And then how much debt do I owe as it relates to revolving debt also has a big impact to my credit score. That's called credit utilization. We're looking at the percentage of my balances in relation to my credit limits. So ideally, we want those credit balances at 10% or less of the credit limit amount. If I'm running a little bit higher right now, maybe I'm still paying off holiday expenses or I booked a trip on my credit cards. We really want to manage down that credit card debt. So if I'm at 80% utilization of credit cards right now, our first benchmark is going to be 50% utilization. Then I want to get to 30% utilization, and then ideally 10% or less. That's where you're going to see your optimal credit scores, like at the 800 plus level. Now, when you think about management of credit card debt, I want to give you a tip to kind of implement today, which is if you can try to pay down your credit cards before the end of the billing cycle or statement date closing, or pay them off, pay them down or pay them off. Either way, we want to, of course, lower that utilization, but you're doing it before the billing cycle date closes. So if you can do that, what you're doing is you're getting ahead of the reporting by the credit card company out to the three agencies. So if my billing cycle date lands today on the 11th and I paid off my balance just before that, I paid it off yesterday. That means when the reporting goes out to the three agencies, I have a higher credit score reflected because my utilization of credit is lower. Last component is payment history. That's going to be pretty self-explanatory. We're looking at how have I paid my bills, especially in the most recent 12 to 24 months. The credit agencies will rate credit delinquencies at 30-day lates, 60-day lates, and then we go to 90-plus day delinquencies. So the higher the number of days delinquent, bigger impact I'm going to have to my credit score. And of course, if it's in the most recent 12 to 24 months. Now, one of the things that appears on my credit report is going to be if I have any student loans outstanding. And student loans are kind of in a weird situation right now because there's some that are in forbearance just because of, there's injunctions in lawsuits going on with student loans. Some are in deferment because maybe you're back in school. And then some are in active repayment. So it's key that when you're thinking about applying for home financing that we have to analyze that student loan debt. So if I had, let's say, $75,000 in student loan debt and I was in my savings plan with my student loan servicer paying $250 per month, I can use that payment right away to qualify for a mortgage. But as I was meeting with a client earlier today, they were not in active repayment. In fact, they were still in forbearance because of the injunction on student loans. Because of that, I would have to assess on a conventional loan 1% of the outstanding balance. On an FHA loan, it would be 0.5%. That's what we would use to figure out the monthly payment, even if you're not actively repaying on those student loans. So that's a conversation that I'm going to have with you during one of our consultations and figure out how that maps to your overall eligibility. But I would encourage our class that, student loans shouldn't hold you back from homeownership. We just have to better understand where you're at financially with those student loans. If you're in a public forgiveness program where you work for a public agency and you have a 10-year forgiveness program, we still have to, until those debts are forgiven, we do have to factor that same calculation into the minimum monthly payment. All right. All right, we're going to talk about loan programs in just a minute, but I just want to make sure the class knows any questions you have, just drop those in the chat or Q&A. I got both windows up on my side, so I'll definitely be kind of monitoring those. But feel free to put any questions in there. Obviously, we have a few more topics to discuss, but just want to make sure you can chime in with those questions. Let's talk a little bit about loan programs. And these are some of the 5 key loan programs that are out there. Probably 4 of these 5 we really use for our first-time home buyers. The first one starts with a conventional loan. That's Fannie Mae and Freddie Mac, minimum down payment of 3%. And every year, those agencies set the conforming loan limit, which right now is $832,750. That gets adjusted every year based upon cost of living numbers that come in. And then it'll get adjusted probably again this September. We'll see that. What that means is in the market that you're going to buy in, we can go all the way up to that loan amount with a minimum down payment of 3%. Now, depending on where our audience is thinking about buying, if you're in LA County, for example, in California, well, we can go up to $1,209,000. That's a higher loan limit, but it does increase the level of minimum down payment from 3% to 5%. So any market in the United States that you're going to finance more than $832,750, that down payment jumps from 3 to 5. Next loan is an FHA loan. That's a Federal Housing Administration loan. That is guess what, a government insured loan because it is federal. Minimum down payment of 3.5%. A little bit lower credit score requirements than what we see on conventional, has a little more leniency in the qualifying. And then the maximum loan amount is different than the conforming loan because it actually changes by the county that you're going to buy in. Now, both the FHA and the USDA loan are what we call government insured loans. So FHA is on the Federal Housing Administration or HUD. USDA is backed by the United States Department of Agriculture. Both of those loans, because they are government insured, do have a different residency requirement. It does require you to be a permanent resident to participate in those programs. With the USDA program, the benefit there is it's a zero down payment option, and it's really designed for clients that want to purchase in more rural areas. A lot of our Kansas markets do qualify under USDA, and so we can certainly look at that as an option for you. But the maximum loan amount will change a little bit depending on what county that you're going to buy in. And there's two qualifiers essentially for USDA is that you have to be in one of those designated rural areas, but you also have income limits by the household size for that particular area that you're looking at. Last product is the VA home loan. That's for our veterans that have eligibility under the VA home loan. The benefit for the veteran is just a little bit more ease and convenience to access home ownership with a zero down payment option, lower credit score requirements, and there's really no loan amount maximum for the VA home loan product. Before I forget, before we kind of move on, I did forget the jumbo loan product, but it's really going to be for clients. I wouldn't see that be popular for first-time buyers because it's higher credit score requirements, but it's higher loan amounts. So we're thinking about buying in, close to the $1 million purchase price range. And really that's possibly our second or third purchase if we go into the jumbo space. But certainly it's a resource available to you as prospective buyers. Now, as we think about home ownership and the expenses that go into my monthly payment, I mentioned this earlier. We want to talk a little bit about mortgage insurance. And mortgage insurance comes into play on a conventional loan when I put less than 20% down to purchase a home. On an FHA loan, regardless of my down payment, I'm going to have mortgage insurance. So if we look at our slide here, we have the PMI side, which is private mortgage insurance. And then the other side of FHA is MIP or mortgage insurance premium. Both elements do the same thing, which is essentially protects the lender against default by the buyer. If something happened, they had an economic hardship or whatever. On a conventional loan, PMI is based upon credit score, down payment, and how much you finance. On an FHA loan, it's kind of a one size fits all. So you have two elements to FHA mortgage insurance. There's monthly mortgage insurance, and then there's upfront mortgage insurance. Now, the benefit on the conventional side is that conventional mortgage insurance has a cancellation option. So once I have 2 years in my home and 22% equity, I can apply to have the mortgage insurance potentially canceled. So if we look at an example of conventional mortgage insurance down here, let's say I was financing $300,000 and I had a 740 credit score with a 3% down payment. Mortgage insurance isn't too bad. It's about $92 a month. On the FHA side, I don't have that cancellation option, and the expenses are a little bit higher because I have the upfront mortgage insurance, which is $5,250 in this scenario, and $137 on the monthly mortgage insurance. So a little bit different between the two products. As I mentioned in our product segment, FHA has a little more leniency with lower credit score requirements, a little bit little more flexibility when it comes to maybe past credit challenges. So as we design your credit options, or your financing options, we'll look at both scenarios, whether it's FHA or conventional loan. FHA is not the one size fits all for all first-time buyers. Many buyers don't realize that you can still do a conventional loan with as little as 3%. So we certainly want to explore the conventional product first. And if the qualifying doesn't work for whatever reason, then we would use FHA as an alternative option. As we look at those products, we also look at the qualifying elements, which would include income. So I want to look at a quick debrief, if you will, on income. I also want to pass along to you guys the documentation needed to validate your income. So as you're thinking about taking on home ownership and going through the qualification process with us as part of a consultation, here's the documents that we would generally ask for. Okay. So pretty simple stuff like W-2s. We probably just got our W-2 a couple weeks ago, so that's all available to us. Bank statements for assets, and then usually the last 30 to 60 days of income statements or pay stubs. Let's talk more about income as it relates to eligible income, because we do have to validate 2 years of income or employment, I should say, as well as included in that is education. I like to share this with our classes because many of our attendees to our classes maybe just finished up graduation, right? And now they're just recently into the workforce. So in financing, I just have to validate work history and or education for the last 2 years. So if I graduated from KU in the fall, for example, and I just started my job January 1st, I can still entertain or include my income in qualifying because I can show that I, had 4 years of experience at KU and I recently started my job. So that income would count towards your qualifying. So the misconception in the marketplace is that I have to be on the job for 2 years to be able to count that income, which is not the case. In my compensation plan, if I have variable components, like let's say a bonus or a commission, or maybe I'm in a job that's hourly and I get a ton of overtime, in order to count that variable source of income, then I have to show that I've been on the job for 2 years. But if I just have a straight base salary job, I don't necessarily have to be on that job for that 2 year period of time. I could have just started a month ago and we could potentially count that income. So that's a little bit of what that looks like, but I want to go a little bit further. Let's talk about self-employed individuals. So if you're self-employed, you're an independent contractor, maybe you get 1099s. In that case, we do have to show that you have 2 years of tax filings in order to count that income for qualifying purposes. If I have a dual employment, so I work for two different employers, in that case, I have to show that I've been working for both employers simultaneously for the last 2 years, and then we can count both sources of income. All right. Last thing I wanted to share with you is around supplemental sources. Let's say I drive for Uber or Lyft on the weekends. Now, that income gets paid out as 1099 income, which gets reflected on my tax returns. That's another scenario why, in that case, I do have to show that I've been in my both roles, if you will, for the last 2 years. Finally, we also have some cases where clients want to include additional income from a spouse or a partner that's contributing to the household, but doesn't really want to be on the loan application. We can't count that additional income unless they're actually going to apply. So that partner would have to be a part of the application in order to include that income. So as we review income for a client, then we take that income calculation. We also review it against expenses. Those expenses would include credit card debt, auto financing, student loan debt, as well as the new mortgage payment, the new housing payment that you're going to pay, right? That housing payment includes the principal and interest of my loan, taxes for that respective home, homeowners insurance. Maybe I put less than 20% down, so I have mortgage insurance. So that goes into my housing expense budget. But then I have to add in those credit cards or whatever other debts I have. We compare that against your pre-tax income. We call this calculation debt to income ratio. And we generally want to see that debt to income ratio no higher than 45 to 50%. Ideally, or maybe the comfort zone for most clients is like 33 to 36%. Here's an example of what that calculation looks like, just so you can get kind of a glimpse into it. So if you were paying $2,500 a month in housing expense, you had $500 in other debts, right? But you were making $8,500 a month in pre-tax income. So that tells us that $3,000, or the calculation tells us that 35.3% of your pre-tax income is going to go out the door to those expenses. And that's good. That's right in that comfort zone. It can be as high as 45 to 50%. We don't recommend it, but in some of our cases where we're helping clients with home ownership, they may have other sources of income, but they just can't validate those sources of income. So in those are scenarios where we want to maybe look at that higher debt to income ratio. We also, of course, would see higher debt to income ratios in higher cost of living areas. If you're buying in San Jose versus buying in Kansas City, those debt to income ratios might look a little bit different just because just the cost of housing in San Jose. Prevailing wages look a little bit different in those markets, but at the same time, cost of housing looks a lot different. All right. Well, the last component to kind of your plan for homeownership is to figure out down payment, right? As we learned this evening, the minimum down payment is 3% on a conventional home purchase for a first-time buyer. Let's talk about what assets or resources we can use for homeownership. Then I want to give you a plan for savings for down payment, and then finally talk about first-time buyer programs. So here are some of the documents that we would consider acceptable sources of down payment. Can be obviously bank accounts like checking and savings accounts. We can't use cash deposits because we have to make sure every asset used in home buying is seasoned for at least 60 days. You can use a 401k account or retirement, 403b, those are all allowed investment accounts. I would always encourage our clients, talk to our financial or your tax advisor before you access those assets. We certainly don't want to create a tax implication for yourself or miss out on opportunities in the market. Now, gift funds are one of those asset resources that don't have to be seasoned. That's where a family member is helping you out with your home purchase. Cash can't be used, but as long as we can trail that money back to the originator origination of the account for the donor, that can absolutely be used in a home purchase. Now, here's an example of saving up for homeownership. And as I work with clients all across the country for homeownership, there is two really kind of consistent things that I think resonate in those conversations. One is housing's pretty expensive, regardless of what market you're in. Two is it's still kind of tough to save right now because of maybe the cost of living, or maybe I'm new in my employment. So as you're considering that path towards homeownership, I wanted to give you guys a really simple savings plan to homeownership. And it looks like this. So let's say I'm paying $1,500 a month in rent, right? And I'm really good with that. I started my new job, things are going good, cash flow is good. And I do my consultation with Jason. And after I do that consultation, I feel like I can afford about $3,000 on a mortgage basis. I'm not ready to buy right now, but I want to save up towards that. So, what I would encourage that client to do in this savings plan is start paying into your savings account like you're making that $3,000 mortgage payment. So, first of the month comes, I make that $1,500 rent payment, but I create that discipline for myself that an additional $1,500 goes right to my savings account. And it does a few things, right? I mean, over 6 months, I've gained $9,000 in savings. Of course, 12 months, I have $18,000. Not only does it accrue that savings account in addition to, maybe some additional interest that I get in a high yield account, it also creates that habit and really behavior of now I'm paying that $3,000 mortgage. So it really doesn't feel like a big leap when I double my outgo and housing expense because I've been doing it for the last 12 months, right? And that is a really simple but a successful plan that can work if you implement it. We've had several clients do that all across the country, and we found it to be really helpful to help them really get on that path to homeownership a little bit quicker. Now, what can even turbocharge that path to homeownership is first-time buyer programs. They're available all across the country. Whether you're in Kansas, you're in Amarillo, Texas, or Denver, Colorado, there are first-time buyer programs available to you. Kansas has a housing resource corporation that provides assistance of anywhere between 15 to 20% of your sales price for down payment and or closing costs. It is designed for more of our low income housing buyers, but the nice thing about it is forgivable after 10 years. But it's only available in certain markets in Kansas. So depending on where you're going to buy, let's talk offline about what market you want to be in. We'll see if that particular zip code fits this particular product. We also have what we call is our 1% program, which is not highlighted on the screen. And what the 1% program does is it allows those that are buying up to a purchase price of $350,000 to get up to about a $4,000 grant back to their home purchase. So let's say, for example, I'm buying a $250,000 home, right? So if I was to buy that $250,000 home and I contributed 1% of my sales price, then we would have that grant go towards making up some of the difference in your down payment, and it's completely a grant. So that's a really cool program that's available in all of our markets across the country. But you do have to be considered what we call a low income housing buyer, someone that makes less than 80% of the median income. Nationally, we have the Pathway DPA program. Now that's specific for FHA loans, but it does provide up to 3.5% to 5% of your sales price in assistance. There are no income limits for that program. Now, not everybody in class is looking maybe to buy in Kansas. So there are first-time buyer programs in basically every state across the country. Some are more funded than others, and some have different requirements, whether that's income limits. There's different income limit requirements, I should say. It can range from 80% of the median income to, like in California, it's as high as 150% of the median income. If you do have some questions around first-time buyer programs and want to use that as part of your plan for homeownership, let's talk after class. We can certainly get you connected with some of those resources as part of our consultative process. All right, we're to the last kind of stage in tonight's class, which is talking about the buying process. And this is really an important next step for you after tonight's class, because I would love to be able to get connected with you for a consultation. That's a free service we provide. So whether you want to buy a house in the next year or the next 2 to 3 years, I think a home buying plan constructed from that consultation is really important for you. So this is a snapshot of where we go from here after tonight's class. So step one is to basically do that consultation, and then ultimately you would be pre-approved, which essentially pre-approval means that you're activated now to start going out and looking at homes and making offers. Doesn't mean you have to do that right away after you do a consultation. The pre-approval is good for 60 days, but your application that you provide to us stays live with us for 2 years. So, I have several KU alum that have been pre-approved for the last year and a half, but aren't quite ready to jump in the market. That's totally fine. We just want to provide you all the tools and resources and really ultimately a game plan so you know what home ownership looks like for you. Now, when you're ready to kind of launch into the home search, that's where we go to step 2. That's the house hunting phase, where it could take a couple weeks, it could take a couple years, especially if you're looking at a specific community. We would always encourage you to talk with a local realtor to help you in that home search. We do have a network of realtors that we work with throughout the country. So if you want us to make an introduction to one of our trusted partners, we're more than happy to make that connection for you. As you go through the home search, and depending on how close you are to finding that right property, or really to maybe pulling the trigger on a property, you're going to probably find a few homes online and then probably explore those properties at an open house or go out and physically look at those with your realtor. But once you make an offer on a house, then that offer might get accepted by the seller, may not, may take a few times to get that successful offer acceptance. But when that offer gets accepted, then we move to step 3 in the process. That's called entering escrow or opening escrow in different parts of the country. Usually from step 3 to step 6, which you can see right here. So from step 3 to the closing phase here at step 6, most parts of the country, it takes about 30 days. Some other parts, if you're, the average close time in, Oklahoma is 45 days, right? So it looks a little bit different in different parts of the country. California, it could be short as 14 days. Some of your more competitive markets, the closing time period shrinks down quite a bit. But once your offer is accepted, then you're going to get a call from me saying, congratulations, you did it. Your offer has been accepted. Then I'm going to walk you through next steps, including your follow-up consultation scheduling, which is where we kind of fine tune all the details of your financing just to make sure it kind of fits everything that you expected with this respective property. You also get a checklist of items to work on, because now the process begins with kind of detailing out everything for financing for you. It does also start some action items on your side, like making a deposit for your house. That essentially secures your house. Most parts of the country, it's 1% to 2% of your purchase price. That will count towards your overall out-of-pocket expense. So we'll have that in place. And then inside of your contract, there's usually contingencies that create protections for you as a buyer to allow you to get your house inspected, get your house appraised by the lender, which would be us in this case, and then of course get your loan approved. It depends on where you're buying. Most parts of the country, it's probably 17 to 21 days of those contingency periods. But it is an important element to the contract because it allows you as a buyer to confidently kind of just do some work on looking into the property a little bit closer. Because from the outside looking in, it might look like a great opportunity for you. But maybe you get inspection reports back and they're not super favorable. So you might want to renegotiate with the seller, or maybe you want to pull out of the transaction altogether. That contingency protects that deposit in that case. As we move to step 4, that's more of the administrative functions of the loan. We're doing processing and underwriting, verifying your employment, making sure essentially the loan is all packaged up correctly, because it now goes in front of an underwriter who underwrites and approves the loan at step 5. Now, as we move through these different milestones, you're going to be getting e-signature disclosures sent to you that highlight everything that we reviewed in your follow-up consultation, which is back here at step 3, which happens in a couple days of your accepted offer. Step 5 kind of gets everything detailed out with the underwriter. We issue that loan approval. And then at that point, we also are at the end of our contingency period, which for you as the buyer, we have to make a decision if everything that we've checked out through our investigations looks good for us and we want to continue in the process. If we do, we give the thumbs up to our realtor, we sign off on the contingency, and then as your lender, we issue to you the final closing disclosure, which basically gives you a 3-day cooling off period before we move to the very final milestone. That's called closing your home loan. In different parts of the country, the timeline of that looks different. In Kansas, for example, you will, on the closing of your loan, you will meet with a title officer that day. You'll wire in your funds that day, and then as your lender, will wire the loan funds the same day. That money gets settled up with the title officer, and then the recording happens the same day. So it's all within that one business day. Now, if you're buying in other parts of the country, it may happen one day we sign the documents and then the next day we close. But all of that's in generally about a 24 to 48 hour period. But that is the one stage where you have to be in person other than looking at your house. But once everything gets confirmed as recorded with a local county recorder's office, then you are the official owner of the home. That's when you're officially done with the process. We call you and say, hey, congratulations, you did it, high five. Now you're the owner. Time to fire up the moving truck, go get your keys from your realtor, and let the fun begin. So that's obviously an exciting day for our clients. Exciting for us too, because now we've come from classwork to like home buying process to getting the keys to our house. So really exciting time for us, and you as well, of course. But our relationship doesn't end there. We have our aftercare product or program, I should say, that really continues our relationship after the closing process. Whether that's watching rates for you for refinancing your home at some point, whether that's tracking your home equity in our HomeBot system, we're going to provide all these different tools to you to make sure you have all the right resources around you. And of course, just staying connected with you on an annual basis to make sure you know what the market's doing. Is there opportunities to refinance your home and lower your rates? Do you have questions for us about general financial tools? All that stuff happens as we check in with you throughout the year. Now, as we conclude tonight's class, we got a few minutes left in our time block, but wanted to let you know how you can get started in the process. So if you're ready to get started with a consultation, which by the way is a free service we provide to our community, that entails you doing an online application. We only do a soft credit check, so you don't have to worry about your score being impacted. You'll upload proof of your income, and then you use our scheduling system just to schedule your free consultation, and you'll be meeting with me one-on-one for basically a home buying plan. Again, you don't have to feel like you're running out to buy a house this weekend. That's not our intention with that consultation, is to provide you really framework to home buying, really a roadmap to home ownership. If you have questions after tonight's class, maybe things that you want to discuss with me from a credit perspective or learn a little bit more about the first-time buyer programs, I would encourage you to do an introductory call with us. That's a great way to kind of get your questions answered. Of course, I'll answer them for you on here as well too. Here's all of our kind of talking points, if you will, in the consultation. So just really a deeper dive into a lot of the concepts that we've already talked about in tonight's class. Last thing I want to point out to you is just our embrace of technology. So you can do things around mobile with us. You'll get push notifications if you just decide to subscribe to mobile, of course, email notifications. And some of the AI tools that are available to us that are done through our HomeBot tracking and stuff like that. So we really embrace technology, but the point of me sharing that with you is it doesn't remove the human element of the home buying process. That is a very high touch process for us. And whether that's having a conversation on a call or video or just simply a text just to kind of check in with each other, the human touch is a really big part of how we support our clients through this really big decision. Last thing I want to point out to you is our discount for our KU Alumni Association and our attendees of this class. So we discount our services when you decide to take on homeownership or even maybe refinance your home with us. We want to make sure that we discount our services. And if you've liked tonight's class, we'd encourage you to share this with your friends, family, maybe some of your coworkers. We will have more classes like this throughout the year. We also have other partnerships across the country. So, if you want to attend or have somebody else attend those classes, they are free to join. Most of our classes we provide are kind of open to the public. Here's all my contact information. So if you want to get connected with me after class, feel free to do so. And we love what our community says about us, whether that's on our Instagram testimonials that are posted, Google reviews, Reddit communities that talk about us quite often. We love to hear what our community says about us, and we really love to celebrate homeownership on our socials. So feel free to follow us, on some of our socials on Instagram. We also try to put out some good tools or resources for you, help you better understand the housing market. We just posted the same video of what we talked about today, which is what's happening with the housing market and interest rates. So feel free to check us out on Instagram as well. That's our class for tonight. I know I didn't get any really questions, but I'm here to answer any questions for you. And of course, we did record tonight's session, so that'll be up on our YouTube channel tomorrow. So before we sign off, any questions from our audience that you want to drop in the chat for us? Anything there? You guys are all still hanging on, so I appreciate that. I'm a little early in terms of hitting the top of the hour because usually go right up to the top of the hour, but we haven't had any questions to weave into tonight's presentation. But if you don't have any questions, that's okay too. I hope I get a chance to meet with each of you at some point in time to help you on this path towards homeownership. We really enjoyed bringing this to you tonight. Again, we'll have 3 other classes available in 2026. So feel free to share this content with those in your community. We'd love to be able to be a partner with them in homeownership. Other than that, hope you guys have a great night. If you're following March Madness coming up soon, hopefully KU does some serious things in the tournament. We'll be rooting for them, of course, and look forward to seeing you soon. Have a good night.